Hi, I am DR.S.BARATH. In this video, I plan to explain about the open interest concept in a very practical way. In this video, I am rather not going to concentrate on how the open interest is being calculated because that has been already been done by a lot of people. So I think that is not important, and also I feel it is not required because already the open interest is being calculated with the exchange and we have the figures. Rather than seeing how it should be calculated, I guess we can see how we can use the open interest to our advantage when we trade as far as monthly or weekly options is concerned. Before going to the video, of course, for a theoretical purpose, we just need to at least see what is the definition of it, and I have got this definition from the Investopedia site. Let me make it very simple and clear. By definition, open interest is the total number of outstanding derivative contracts such as futures or options that have not been settled for an asset. Okay, now what is it basically? In simple terms, say at a particular strike, when we open an option chain, we see a number of contracts being traded, and then we see the open interest. When the open interest is more, it indicates that more activity is happening at that strike. Suppose say a put option, say for example the 15,500 put option is having the maximum open interest. It is considered as a basic support level. Similarly, as far as the call side is concerned, say for example maximum number of open interest is there at the 16,000 level, then that would be fairly assumed as a good resistance for the market. Now why this is assumed as the support and resistance? Generally, the open interest is taken from a seller's point of view because a seller is supposed to be more informed than a buyer. So say since the more contract is being sold by the sellers at 15,500, it means that they are more confident that the market will not fall below the 15,500 mark. So they sell more number of puts at that level, and generally that would be taken as a support. Similarly, since they are selling more number of calls at 16,000, they feel that the market is not going to go above 16,000, which means they are not very bullish, and that would be taken as a resistance level. Now we all know that the sellers has got a success rate of around 80%, which means mostly they will be winning, but 20% of the time the seller still has a chance that they will lose. What I mean to say by this is, out of every 5 trades, if you do it based on open interest, at least 4 or 3 trades would be successful, but then 1 trade or 2 trades may go absolutely wrong if you only decide your trades based on the open interest, because as I told you, 20% of the chances the buyers do win, which means you should not take a trade only based on this parameter from a separate viewpoint. You have to take it along with the market condition. It is one factor which has got to be considered before you put a trade. It is not the absolute, it is a reference trade. So this point I want to make it absolutely clear. Now as far as retail traders are concerned, what I observed is most of them, they open an option chain, they see the open interest column. That is the only thing that they see. But I personally feel there is one more column which is more important than the open interest column, that is the change in open interest. And this is even more important when you consider doing weekly trades, weekly expiry or any weekly trades. Now when we observe the change in the open interest column, for example, say you want to sell a weekly straddle, say for example you saw that the maximum open interest is there at a 15,700 straddle, you sold it, and then if you just leave it as such, as far as the weekly option is concerned, as the expiry is nearing, this change in open interest column shows a very dynamic figure. The 15,700 straddle may no longer have the highest open interest, it keeps shifting, it shifts to 15,800 or probably to 15,600. Before this is happening, the change in open interest column will denote what is exactly happening and what may happen in the market. So we can ideally have some clue as to what may happen in the market. So all the traders who are supposed to do in the weekly trades has got to focus more on how the open interest is actually changing. And then one more point that I observe from most of the traders, what they do some mistake is they treat the open interest from a very narrow point of view. Say for example the market is around 15,800, they only see the 15,500 or till the 16,000 strike. that will not give us an exact picture of what is happening in the entire market. We have to analyze the column in a more broader way. You have to see the open interest, what is actually happening in the entire section. When we do that, we may have more clues as to what more informed investors are doing. For example, for the last 1 or 2 weeks, I was able to observe that some of the very clever traders, when the market was around 15.4 or 15.3, they were in fact selling 16,000 put options. So only if we have observed what is the change in open interest is happening, we'll know what the more clever traders are doing. When we do this, we saw that at least sizable number of contracts, I don't mean by 100 or 200 contracts, at least 1,500, 2,000 trades were being added at 16,000 levels, at more deep in the money options. When we see these kind of trades, we need to know what is exactly happening. When the market is around say 15.3, they were very informed and they were able to sell a deep in the money put option, and they did profit hugely from that. So we can at least have some clues as to what the clever investors are doing or clever traders are doing. We cannot blindly go and do that, but at least we can have some idea about what may happen in the market. When at least 2,000 or 3,000 contracts are being added, say very deep in the money put option, we need to have some clue, we need to be more aware. So that is why analyzing the change in open interest column becomes even more important, and please analyze it from a more broader point of view rather than not having a very small view. I would also like to make one point very clear in this video. Most of the sellers or new retail traders, what they think is when they see an open interest which is maximum, say for even a monthly contract, say for example 15,500 strike, they see that the maximum size is there, the maximum number of open interest, which means they assume it to be a fair support. That is not wrong, but not always the case. You have to keep observing what is changing. Say the market is becoming a little bit more bearish, which means say from 15.8 it is coming towards 15.6, that is coming towards the strike. What happens to the sellers is they will be more worried about this 15,500 put option that they have sold. They will shift the strike from the 15,300. They may move say 200-300 points away. Say for example they are moving to 15,200 strike. The number of open interest in 15,500 strike may reduce, and then the support may be broken. And by analyzing the change in open interest, you will be able to know what is exactly happening, and you will have to be ready to shift your view if suppose the support is being tested. And more importantly, as the market is becoming more bearish, all the people who have been having long position in the market, say for example future longs or so, they will be squaring it off, which means it is called as long unwinding. And as the long unwinding happens, and when the market assumes that is approaches towards the maximum open interest strike which was there earlier, the chances of market falling down is more. So as the long unwinding happens, that itself will propel the market downwards more. Similarly for the call side, say the 16,000 call was written, as the market moves violently up towards say 15,900 and 950, all the sellers who sold the 16,000 calls will be worried, and whoever was having short position will be worried, and this will create a short unwinding. So what happens is, as the short covering is done, the 16,000 strike would be easily tested, and then the market can go further up. So what I mean by all these things is, don't simply think that a support and resistance can be taken from an open interest point of view alone. That will not work for all the situations. It can be easily broken. So you also need to be aware that you need to analyze the market price action pattern and all these things along with the open interest, and just don't take it as an absolute reference. It is not an absolute reference. It has got to be taken along with what is happening in the market. So I think these are the only practical points that I wanted to discuss about the open interest. If there is some comments, you can always post me the comments in the section. I hope this video was of some help to you. If you like this video, please consider subscribing to this channel. Thank you all for watching this video patiently. I wish you all a very good health. Thank you.